Hey everybody, it's your boy Joe the Wealth Architect. Today I want to talk about actually investing, right? For those of you who have been following the channel, it's a new channel. And so I've been talking about a range of things from the SSI method, my wealth building framework. I've been talking about mindset, the importance of mindset. I've been talking about mindfulness, talking about in general having an ownership mindset as opposed to a consumer mindset, and a few other things. But today I want to actually get into investing. What does that entail and how you should get started with very little. And what I advise a lot of people, and I'm not a financial advisor, I will say that, but what I advise people to do who are just getting started is to not invest in an individual stock, right? Like Apple, Google, Netflix, or whatever, although they can be profitable, and I do own shares in each of those companies and more, but that's because I feel comfortable investing. I've been investing for years, been studying for even longer. But what I encourage people to do is to start with an index fund, right? An index fund, particularly an S&P 500 index fund. So before I get into steps to investing and what particular index funds to invest in, I want to talk about what is an index fund and what, basically what is it all about. So an index fund is essentially a basket of stocks, a basket of bonds, or any other what they call securities, right? These types of investments. So rather than invest in an individual company, as I mentioned, like Starbucks, like Nvidia, or any of these other companies that you may be familiar with, an index fund will have sometimes dozens, sometimes hundreds of these companies in one basket. And what that means is that when you invest in an index fund, you're investing in an entire basket. And what that does is it spreads your risk. It spreads your risk, right? So rather than putting, as they say, putting all your eggs in one basket, you're putting your money in several investments at once. So you're spreading it out, which in theory at least reduces your risk, right? Risk of your investment going down, right? And if it reduces it, then essentially the way I look at it is that it increases the chances that you will make money, right? And who doesn't want that, right? So an index fund, again, and there are hundreds of index funds, and I think that's one of the reasons why people get so confused about how to get started, right? They might say, oh, I don't want to, you might instinctively feel that you don't want to invest in one company, right? But you don't know where to begin. And so with an index fund, it actually takes a lot of the guesswork out for you, all right? One of the good things about an index fund is that they have very low fees, very, very, very low, right? Less than a fraction of 1%, right? When I say fees, most mutual funds, which are similar to index funds, in that they are a basket of different types of stocks or bonds or other securities, those types of funds, mutual funds, usually have a high, what they call expense ratio, meaning what percentage of your money is going to a mutual fund manager, someone who picks, selects the investments, right? Like that is their job, that they select investments for a particular portfolio or mutual fund or basket, whatever you want to call it. With an index fund, it's all computerized. So a certain percentage of, in other words, so your money goes into a fund, and it is already allocated in such a way where, let's say 10% might go into Apple. I'm just using that for example. 5% might go into Nvidia or Meta or whatever the case might be, but it's already calibrated in advance. And so it doesn't require an individual, a person to manage, which means that it costs less. It costs less. There's no human overseeing it, so it costs less. So to operate, which means that it costs you less to be invested and to have your money working for you. The name of the game is to have your money, as much of your money working for you as possible. That's the name of the game, right? Not to work for money, as we've been taught, but to have the money work for you. And so with an index fund, particularly a low-cost index fund, your money is working for you, right? Like 99.9% of your money is working for you while you do whatever, while you're on vacation, while you work, while you're in retirement, whatever the case might be, your money is working for you. And that is the key to wealth, right? The key to wealth is not working for 40 years from the time you're 20 to 60 or 65, and then you live happily ever after. That's for most people, that's a dream. That is a dream, right? Nothing wrong with working, but you want to make sure that your money is also working, and that is actually working harder for you than you are working for it. And so, again, the key is to have your money work for you. So with an index fund, like Vanguard's S&P 500 ETF, Vanguard is the name of the company. S&P 500 is the index fund itself, and it's an ETF. So I'm gonna break all that stuff down in a second as I walk across the street and not get hit by a car. So again, Vanguard is the company. There are a whole bunch of companies. There's Fidelity, there's Charles Schwab, there's a whole bunch, right? That offer these, and these are companies that are licensed, right, by the SEC, the Securities and Exchange Commission. So you don't have to worry about somebody stealing your money or anything like that. These people are licensed. The government agencies are paying attention to them because a lot of people think, oh, well, I just put my money in the bank and at least I know where my money is at. And the truth is, you may know where your money's at, but it's not working for you at all, right? It's working for the bank. And people who invest. It's working for investors. That's the name of the game. And so an S&P 500 index fund is an index fund, as the name suggests, that invests in 500 companies. What 500 companies? The largest 500 companies in America. The largest 500 companies in America. So chances are those 500 companies are not going to go bankrupt, right? Or they wouldn't be the largest 500 companies. So let's start there, right? The S&P 500 is broken down. The index itself is broken down into 11 industries, right? Can't remember all off the top of my head, but it goes from industrials, consumer, consumer staples, there's financials, there's healthcare. So your money, when you invest in an S&P 500 fund, is spread out among 11 different industries. So even if you have $200 in it, $500 in it, invested, it is a percentage is spread out through all of those industries and companies in those industries. The term that is used is diversification, right? So your money is diversified. It is spread out. And that is critical. That is critical, meaning in terms of lowering your risk, right? Now, let me be clear. There's no such thing as no risk. There's no such thing as no risk when it comes to investing. Whether you invest in stocks, bonds, real estate, a company, or whatever, there's no risk in life. There's always risks, right? So just keep that in mind. There's no such thing as no risk. Anything that is low, like extremely low risk, usually means low return, right? And if you're fine with that, then that's fine too, right? So a CD, a certificate of deposit at a bank, is not an investment, but it is very low risk, right? Which means you're not going to make a lot of money off it. An S&P 500, right, fund, like I said, there's 11 industries that are invested, and so your money is spread out, and that gives you some comfort. Now, historically, over the last 90 to 100 years or so, statistics show that S&P 500 funds, again, remember, they're funds offered by a whole bunch of companies, and the difference is that they will have different percentages that they will allocate funds to, right? So one company might invest 10% into Apple, whereas another company might invest 7% and put more money in a different company within the technology industry, right? So that's the main difference, how much money or percentage of the money that they collect from investors like you and me, how much is allocated into what industries and what companies. That's the main difference, right? But once they are set, right? And again, like I said, it's low expense ratio, so it's not going to cost you much at all. The vast majority of your money will be working for you. So an S&P 500, like I said, index fund, in this case, a Vanguard S&P 500 ETF. An ETF, right? Now, I know this is a lot of information. If you want to know more about this, click the link below, and you can get a free copy of Chapter 1 of my book, The New SSI Method, where I talk about the importance of having a spending plan, a savings plan, and an investing plan, right? So again, check the link below for Chapter 1 of the New SSI Method. But an index fund of ETF, an ETF is a variation, right? It's a variation of traditional index fund, right? Again, remember we said index fund is a basket of funds, and so in this case we're talking about the S&P 500, and let me just say this too, the one that I invest in, right? And there's several that I like, but the one that I have some money in is the VOO, right? What is the VO? What does that stand for? That's the Vanguard S&P 500 ETF, right? That's the name of the index. The ticker symbol is VOO. Every company, whether it's a mutual fund or an individual company, has a what's called the ticker symbol. You could think of that as its nickname or short name, right? That's how the industry, the mutual fund and the financial industry, recognizes that particular company or fund. So in this case, we're talking about VOO. You can Google VOO and the Vanguard S&P 500 ETF will come up. An ETF is something relatively new. I mean, it's not new, but I remember reading about it when I was incarcerated, actually. I had a subscription to Kiplinger's Personal Finance, so I always stayed on top of that stuff, and this was 30 years ago, right? And an ETF is an exchange-traded fund. An exchange-traded fund. That's what it stands for. And terminology is important, and I'll do another video about some of the key terms that you really need to know when it comes to this, because terminology, money psychology, and language, all of those things are critical. And an exchange-traded fund is basically as it sounds, right? A lot of these things, when you say them slowly or say them repeatedly, they become easier and easier to understand. An exchange-traded fund, right? So let's break that down. What exchange are we talking about? Well, we're talking about the stock exchange. That's what we're talking about. We're talking about money, so we're talking about an exchange traded. So trades that are made on an exchange, right? And that could be the New York Stock Exchange, the American Stock Exchange, the NASDAQ. NASDAQ stands for National Association of Securities Dealers Automated Quotient, right? A little fancy, I still remember that. And that is basically tech stocks are usually on that, right? Tech stocks are usually on, or the primary ones that are listed on that stock exchange. So an exchange traded fund is a fund in this case, an index fund that we just said that it's a basket of funds. It's an index fund that is traded on a stock exchange like a stock. So every day throughout the day, every day that the stock exchange is open, right, people can buy, or in companies or individuals, schools, colleges, all of them, they are in the market, and so they can trade these exchange traded funds, right? So that why that's important is because with mutual funds, the traditional mutual funds, which are similar to index funds, but they're not the same, right? They are not traded like on a day-to-day basis, like throughout the day, like a stock. They're not, right? So instead, they are traded. How does it work? At the end of the day, is whatever the what do they call it? Net asset value, NAV, whatever the value that it's at that time. That is what someone can purchase it at, right? I mean, it's just that simple. So it doesn't fluctuate throughout the day. It's at the end of the day, it's at a certain value, and that's when people can buy and sell. So it's a lot more static, right? It's a lot more static with a traditional mutual fund. With an exchange traded funds, which have become very popular, as you can imagine, they can be traded throughout the day. And the reason why I say they become popular, because people like the opportunity to be able to buy and sell throughout the day, right? People want to be able to get in, so to speak, or get out of an investment throughout the day, as opposed to having to wait at the end of the day to find out what the net asset value is. So without getting into the weeds too much, my main point is that ETFs are becoming incredibly popular. They have brought in trillions, with a T, trillions of dollars over the last, let's say, decades or so on a consistent basis. And so it's something that you want to really consider. So here's what I'm getting at. If you want to get started with investing, right, I would suggest, right, again, I can't advise, can't give financial advice, but I would suggest that you start with an index fund. And there's a whole bunch of index funds. You don't have to invest in the S&P 500, but you want an index fund because you want diversification, right? You want to spread your risk. You might have a low risk tolerance, high, it doesn't matter. You want to start with an investment that is not concentrated in one stock, right? You don't want to look at investing as gambling, right? And that's the perception that many people have, right? Are there risks? Yes, I said that earlier, right? But this is not about gambling, right? You don't want to gamble away your future, right? That's not what I do. I don't think it's about investing. It's about planning for your financial future, for your family future, and things like that. So I would suggest that you invest in a company, right, like Vanguard S&P 500 ETF. As I said, the ticker symbol is VOO. You can get started with less than $500, less than $250, because there's no minimum, right? Some mutual funds, some index funds require a minimum of 1,000, 3,000, 5,000, right? Most don't, but some do, right? But with the Vanguard VOO, right, there's no minimum. So you can start with $100, literally. So even though now there will be a price, I haven't checked in a little while, so it might be $300 a share or $400 a share. Even, let's say if it was $400 a share and you invested $100, then what would happen is you would get what they call a fractional share, a fraction of a share. So in this case, you would get a quarter of a share. If it's $400 a share and you can only afford or only want to dip your toe in the water with $100, then you would have 0.25 shares, right? That's a quarter. You have a quarter of a share, you'll be invested. You're a shareholder. Right? And so you can get started with just that. And then what I would advise is that what I would suggest is that you automate future spending, so that every time you get paid, for example, you can have $25, $50, $100, whatever you can afford to go directly to your fund. Pay yourself first, right? Don't go shopping. Don't go buying a bunch of stuff, getting other people rich. Pay yourself first. So that's basically the key. So in another video, I will talk about the process of going through actual investing, but I will just say this, right? I'll do a deeper dive in another video, but the process in short is this. Let's say you want to go ahead and invest in the S&P, the Vanguard S&P 500 VOO, as I just suggested. You got $100. Let's say it costs per share, so it's $400, so you'll have a fraction of a share. The first thing you want to do is go online, right? Google is really that simple. Go and type in VOO, right? Type in VOO, or you can just type in index funds. And if you want to look at some other things, but type in VOO, the fund is going to come up, right? The fund Vanguard is going to come up in the in your browser. Or once you type it, it's going to come up on Google. And then what you do is you go click onto the site, right? Real simple. And then you're going to be on the Vanguard on their website. You type in somewhere, there's going to be a search bar, and you're going to type in VOO, all right? The fund is going to come up. It's going to give you a whole breakdown of what's in the fund, what the expense ratio is, the fact that there's no minimum. All that stuff is going to be laid out right there. So you look over that stuff, and then it's going to say somewhere, open an account. So you open an account, right? So you fill out the application. They're going to ask you to do, basic stuff, your name, one of the key things, they're going to ask you your social security number, and then they're going to ask you what your bank account information, right? Because your bank account has to be connected to the Vanguard account. It's actually a brokerage account that you'll be starting, right? And so again, the whole process, we're talking 5-10 minutes. 5-10 minutes could make the difference to begin to change your financial life. 5 to 10 minutes. Really, right? So you fill that stuff out, your name, your, probably address, stuff like that. Social security number, bank account, your routing number, and the account number. Those are the two things. That's it. So they're not all in your business. You fill that out. Then the next thing you're going to have to do is you're going to have to fund the account, right? So what do I mean by that? So you've opened the account, you've connected it to your bank account, and now it's time for you to put money in the account, right? So they're not going to do it for you. They, the mutual fund company, or in this case Vanguard, they don't have the ability to go into your account to take your money or anything like that. It's your money. You direct it. You tell it where to go and what to do, right? And so you are going to fund it, right? So let's say you're starting with 100. Let's say if you have more, the better. More, the better. But let's say you start with 100. So you have $100. You have $100 once you have a brokerage account set up. It'll say they may say something like fund the account or put money in the account. So you'll instructed to take $100 from your checking account to go into your new Vanguard S&P 500 ETF, right? It's that simple. And then you are all set to, in other words, it'll ask you how many shares you want to buy, or if it's a dollar amount, because that's usually how they do it. Either you can purchase shares or a specific dollar amount. At the end of the day, it's the same thing, just said differently, right? And then you'll be an investor. It's just that simple. And then now on the Vanguard site, you can, like I said, you can automate. So you can say how much. You can say that you want $50 every 2 weeks on a specific day to go into your account, right? Into your investment. And that is the smartest way to do it. So you don't have to say, well, I have money now, and then next time when I get paid or when I get my income tax or whatever. No, automate it, right? Just like the government automatically takes money out, taxes us every time we get paid. Pay yourself first. Pay yourself first. So basically, in about 3 or 4 steps, you can be investing, right? You can start your investing journey. And then I would advise you to subscribe to this channel, to the Think Outside the Cell channel on YouTube. Tell other people to subscribe so that together, collectively, we can become much more knowledgeable when it comes to this stuff, a lot less fearful and anxious when it comes to it. I always say that, people say, well, isn't investing risky? Sure, it's risky. But let me say this, especially for formerly incarcerated persons like myself who have served 10, 15, 20 or more years in prison. To me, it's much more riskier to not invest. And I'll do another video on that alone because I think it deserves that much attention and time, right? It is a lot riskier to not invest. What do I mean by that? To not have any money, right? When you're 60, you're 65, and you've done 20 or more years in prison, to not have any investment money is risky because you're not likely to have any money for Social Security because you weren't working. You may be working in the prison, but you wasn't working out here. So there's no rainbow at the end. There's no 401k investment. There's no IRA. There's no investment. And so you'll be dependent on the state. To me, that's a no bueno, as they say. No good. No good. There's no way I would live like that. And I urge you to really get started when it comes to investing. Dip your toes into it and rethink risk. The real risk is not having a comfortable retirement. That is the real risk, right? And we don't want that. So think outside the cell, the YouTube channel, and you can get a free copy of the first chapter of my book, The New SSI Method, right? And the book is focused on us. It's focused on us, people who did time, people who served time in prison. It's focused on us building our own economic blueprint. There's no one else laying it out like this for us, right? And it's by us, it's by myself. I've been 30 years in the game, right? So again, get started now. Don't take anything for granted in terms of, well, you'll figure out down the line, because that's not safety. That's very risky to think that everything will just take care of itself, because it will not, all right? So with that said, this is Joe, the Wealth Architect. And again, click on the link below for chapter 1 of my first book, The New SSI Method, where we talk about a 3-part framework for building wealth and get started with your first investment. And if you have any questions about anything that I've said, leave a comment in below. If you have any suggestions, things you want to share about other types of funds or investments that you think our community should consider, right? Because again, we're not giving investing advice, but things that we should consider, or you'd like me to talk more about, don't hesitate to leave a comment below. I do read the comments, and I look forward to getting this money. Let's do it, and enjoy the rest of your day. Peace out.